Hello. Hello, can you hear me?
Yeah, I can.
Thank you. You're very sharp. Thank you so much. Thank you. Just before we start, I took a sip of water. So I'm really grateful to do this one. This was your idea, and I'm so grateful for, because last several weeks I've just been just going with your ideas. So I'm really grateful for that. Thank you. I really can't thank you enough for that. It's so helpful because, particularly, I spent a lot of time over the weekends thinking about, what can I put together. I kind of think about it over the weekend. I felt like, what can I put together that is practical? It's not just some platitude about markets, whatever. I want to provide something that's impactful. I want to provide something that is happening right now as well. So it's like sometimes I kind of get carried away with my own stories, but it's really helpful when I can kind of say, okay, this works in this instance, and it hasn't worked. The same idea hasn't worked in that instance. And as we go through today, I'm going to talk about. I don't want to kind of jump too much because I think a couple of other people might be coming. But basically, I'm going to talk about when things do work, and then within the same person, some kind of aspects that perhaps don't really work, and just to think about that. So I'm kind of hopefully trying to provide a tiny bit of a nuance to this. I'll just give it another minute because I felt that someone else was going to come because they just wrote to me before. Maybe they're not coming anymore. Don't know. Let me just leave my notes prepared in case I need to jump back into my notes. Yeah, okay. Anyway, how are you? You good?
Very good. Good time. Yeah, everything is generally right. Great.
Yeah, I have a similar attitude as well to life as well. As long as you're breathing, you have another chance, right? Just you always have another chance. You can just don't give up. Okay, so without further ado, I'm going to talk about free investors. I'm going to talk about Warren Buffett. I'm going to talk about, obviously, Charlie Munger, and I'm going to talk about Peter Lynch. So these are the three I'm going to talk about today. And then next week, I'm going to talk about Monish Pabrai. I'm going to talk about Joe Greenblatt, and I'm going to talk about Walter Schloss. So the way I'm going to do this is I'm going to talk for about just 10, 15 minutes, and then we can kind of talk and kind of bat ideas off each other. And I leave it open to you. If you either today or at some other point you want to say, oh, listen, this is something else we can discuss in the future. You've given some really great ideas already. So I've got like a list of things that are kind of broken into it. So I've got today and I've got next week, and then we're taking a break for Christmas. So basically, with Warren's, I think, the most important thing that he talks about is that kind of don't lose money. And it sounds so easy to say. It's really, really difficult. And what is particularly difficult is, when you're down, I don't know, like 20%, it's not much to come back, right? It's not the end of the world. But when you're down 30% on a stock, like you have to come back up 43, let's just say, just for round numbers, 45%. If you're a stock that does 45%, you put your hands in the air, you just go mental. You absolutely like nailed it, killed it, cocktail party, tell everyone about it. But that's really what you need to just recuperate. So, this kind of don't lose money is kind of really easy to say, but it's really, really difficult to think about. Hi, Nicola. Can you hear us?
Yeah, everything's fine.
So I'm just saying to Tomas, basically, we're gonna run through three investors. We're gonna talk this week about Warren, Charlie, and we're gonna talk about Peter Lynch. And next week, we're going to talk about 3 different investors. So we're just explaining about that kind of idea that about Warren's pick of talking about don't lose money. And then when possible, we're going to talk about, some drawbacks of this type of strategy. So the one thing that is difficult to implement about Warren's investment style is that he is extremely brainy, extremely powerfully minded, and he kind of does this kind of Nebraska kind of speech about it, but he's like one of the smartest people in the world. He could have done anything. He could have been a surgeon or whatever. It didn't matter. So he's extremely smart, and we can't really expect, anyone can't expect to repeat that. So that's the first thing. But he's able to be extremely, extremely patient. Now, that being said, a lot of people think that Warren just always buys and holds forever. That is not true. Where I think is really not discussed a lot is that he actually churns out of the smaller positions in his portfolio. They don't make a lot of headlines because there's the big billion-dollar companies that are there, like Apple, Coca-Cola, and Exxon, Occidental. Those ones, like serious amount of money put together, and he's quite static there. And I've never seen expressed like this, but since everyone has written about Warren's portfolio backwards and forwards and backwards, I'm sure that it's been said at some point. But I think that what he's trying to do is just replicate a slice of the economy. I don't think he's particularly trying. I know that he kind of talks, praises management and this and that and the other, but I don't think he's really trying to pick the best business. I just think he's trying to kind of, okay, I'll take a slice of tech, I'll take a slice of oil, and I think it's just like that. Just buying when these things are kind of generally sentiment is depressed, and that's really what he's trying to do, although I don't think he quite articulates like that. But he can be extremely patient in waiting for things to come along. So the example that I think about here is that he closed up his partnership fund in 1969. And I know he was kind of still managing his own money in that period from 1969 to 1972, but he wasn't really doing much. It was like just a very much keeping to himself. So it wasn't quite 3 years, it was like just 2 years and a bit. But there's that period from the end of the 69 into the early 71, 72, where he's not doing anything. Now, I know it will be impossible for me not to do much significant. Particularly if I see something, I'm like, oh, I can make it work. And we often find ourselves trying to overtrade into the market. Now, I don't know if many people would formulate it like this, but when the market is doing well, people are like, okay, I'm going to buy this, I'm going to buy that, and da, da, da. But what's actually happening is we're buying into the same trade, or the technical word is buying into the same factor. The factor may be only discovered after the fact. For example, I kind of talk about if you look at Upstart and you look at Open Door Technology. So I don't own Upstart, but I do own Open Door Technology, and that's really the same bet. One is real estate, and the other one is about funding out money to individuals. But it's really the same bet that the person is doing on interest rates. So obviously this is now a well-known factor, but there are other factors like this that happen, and you only realize this after it's happened. So I think that my biggest advice that I put is don't go too hard into the market at once. Just, it's no stock can be the next Tesla. No stock goes up in a straight line, no matter how amazing it is. Even Tesla or Nvidia, whatever, it never goes up in a straight line. And we think that these things are diversified, but we only find out afterwards that they weren't diversified. So that's kind of like the thing that I wanted to highlight. The second thing within Warren strategy that I wanted to talk about is this idea of circular competence. Now, this is such an overused term. It doesn't matter whether your circle competence is looking for just retail companies, or if your circle competence is just looking for growth companies. It doesn't matter. What you're trying to do is refine your investment strategy so you can nail it. When a stock comes in to what you've worked really hard at for the last several years, and it's in that little circle of competence, you can recognize it. But also, I think that it's important to be very brutal with yourself and say when you've missed something. So I missed a stock that I should have had it. It should have been mine. It was Samsara. I've been following this company for a little while. It doesn't matter. It's just a little company. And it was like, it was there for me. And I didn't take it. But I've had a bit of time to think about that. So yeah, I didn't take that pitch. It would have worked out excellently. But on the other side of the equation is that maybe it's just the same quote unquote factor that I would be investing in, and I'll find out that later because many things are working in the portfolio right now. So, you know, it again going back to that to Warren's investment style. Just it's okay to try and cool your horses down, because if you work hard at this and you stay within that circle competence, it's more important not to lose the capital than to try to make it. You can always make more money. Like it's crazy to say that, but you can always make more money. What you can't do is you have to work not to lose the money, and that's different because everyone in the market is making money. You know, like stocks are going up, everyone's like singing and dancing. But to keep that money, that's really where the magic is. And I think that that's like my second point that I wanted to highlight about Warren strategy. And finally, this has helped me out quite a lot. So I have a stock that's not working for me. It's really killing my portfolio, which is Albemarle. They mine lithium. It's killing me. Like it's like just literally a massive drag on my portfolio. And I know that. But Warren always says, buy stocks that you'd be comfortable to own if the market was closed for 5 years. So our stock is killing me, and I recognize that. But if markets kind of get over infatuated with news flow. But when stocks are moving in a direction, up or down, it creates a lot of jazz, a lot of news, a lot of content. People kind of get really caught up in this kind of stuff, and it kind of gets overextended on the upside or the downside. But when I buy a stock or when I recommend a stock, I think long and hard, is this a business that I'll be comfortable keeping? And if that's the case, if I'm comfortable keeping that business, that's a good investment to make, because I'm not trying to play a hero when the stock is going down. I'm kind of buying and buying and buying and buying. Like, that's not what I'm trying to do. I buy the stock and I give it time. And it's important, that thing again about the patience, just give things time, because things kind of get so heated in the moment. And then you look back and it was actually not a big a deal. So as an example, it's now 14 months ago, last October, gosh, man, every podcast that I was listening to, it was the ends of the days. Everything was coming to a collapse. It's like the massive, the inversion of the interest rates. People were just going like all kinds of, and it's like they call it bear porn, because it just sounds so jazzy, it's like sounds so intelligent to kind of say, oh, I know that the market's gonna fall. And I'm not sure if it was Zig Ziglar or John Templeton that said this, but I think they both said kind of the same thing, that journalists have successfully predicted 10 out of the past 2 recessions. So it is just always like saying, oh, there's a recession coming. And it sounds interesting. Yeah, it's that person knows something. But if you just look at, let's say, the S&P 500 over a period of 5 years or so, most of the time, I know that this is not always going to be the case, but most of the time, the stocks tend to go up. Now, 5 years is a really long time. And when I invest, I always say, okay, try and see the vision for where this business is going to be next year. It's much easier to see where it's going to be next year than where it's going to be in 2 or 3 years' time. Okay, so I'm going to move on to.
You said.
Yeah.
Yeah. So, sorry. So you said generalists have predicted correctly 2 out of the last.
Journalists.
Journalists.
It's okay. Okay, that's interesting.
Yeah, it's a quote from Zig Ziglar, but because he was a salesman. He is someone that, the great thing about a salesman and people of vision, like a CEO or whatever, an executive, is you're selling people on your idea, your vision. And Zig Ziglar was a terrific salesman, and he distills a lot of these principles into kind of sound bites. And obviously, he was big in like the 60s and 70s or whatever. But the point is that those ideas, those principles repeat themselves over time. And it's just, it's important to kind of, we'll come on to Charlie Munger's, but in a minute, but it's important to have this kind of multidisciplinary approach to investing. And yeah, I'll come to that in a minute. Sorry, I'll come out. Okay, let me just momentarily. Did you ask a question? Sorry, Nick, did you ask a question?
Yeah, and so the lesson that you mentioned before is buy stocks for which I couldn't hear precisely. Buy stocks and hold them or have a 5-year vision for it.
So what I was saying is, you need to buy stocks that you're comfortable owning for 5 years. You don't need to own them for 5 years, but the Warren's quote is something. You should be buying stocks that you be comfortable if the market closed for 5 years.
Okay.
So I gave the example of a stock that isn't working. I wanted to be like fully transparent and give examples because obviously I can talk about things that are working in portfolio. Like most of the tech stocks are just like sizzling. But I wanted to put out and explain when things are not working as well, because it's much more interesting, I feel, when you're trying to kind of have a moment of self-reflection to talk about things that are not working. Because I personally found that I gain more value from my own teachings and from my own lessons when I spend time thinking about how did I fail? Could I have seen that beforehand? Because when a stock goes up, everyone is happy. There's no questions asked, and it's no point, right? No one's going to second guess you. But when the stock is going down, you have an opportunity. Like, you lost a lot of capital, but you have an opportunity to think, okay, yes, I failed. Could I have worked a little bit harder on something? You can always try to work a tiny bit harder. And I found that those tiny bit harders, like, it's just a little bit harder, but they add up over time. They really add up, and they make a big difference. And things sometimes take a really long time, but like you get, I know it sounds like a clickbait, but it's like you get a little step function. You kind of just inflect, and it's like, okay, yeah, I got that. And it's just like falls in like a piece of a puzzle, and it's like it becomes like second nature. You won't do that exact mistake again if you keep going over your previous mistakes. Okay, so I'll talk about Peter Lynch next. So Peter Lynch's, the one thing that I like about Peter Lynch's investment style is that he spends a lot of time talking about the price to earnings growth. Okay, that's the price to earnings ratio divided by the growth. Okay, just for round numbers, if the price to earnings is 30 and the growth of the business is 15%, then you take the 30 divided by 15, you get 2. So anything around 2 or less is generally considered a good investment to make. Above 2, or even like if you're paying, for example, a really high PE relative to the underlying growth, you may already be paying too much for high expectations. So this rule, this PEG ratio, price to earnings growth, is really, really helpful to get you out of trouble. Because I have seen this in countless occasions where people build up narratives why stock XYZ is like something going to be something really, really strong. Particularly on Twitter, I see it a lot. And people kind of spin these webs onto themselves, and they kind of, man, they articulate it so like amazingly, like they add all these different points and this and that, and they met with the CEO, and there's picture of them, the CEO, and it's like, but you know, those things work until they don't work. And you need to, if you come back to this PEG ratio and you just keep yourself out of trouble like that, I think that's really helpful. The other thing that what Peter Lynch talks about is kind of like the circle of competence, but try and invest in businesses that are kind of easy to understand. Now, that worked very much in the 80s. I feel that over time, things are getting much more complex. But that being said, you must have a general idea of what the business is trying to do, just to make sure it kind of rings true. At the top of my mind is Palo Alto Networks, because I just literally wrote about that. But basically, you know, I have some kind of vague idea what cybersecurity is. I'm not an expert, you know, I'm not a tech guy, but I kind of understand, right? I kind of get the general idea. You read around, see what the peers are doing. Just, you know, obviously each CEO will talk about why their company is the best. I get that. But see if there's some kind of common themes around it, right? If everyone is saying that there's softness in the market, and one company saying, oh, everything is excellent, you know, just question that, have a bit of analytical thinking, and just say, okay, you know, does this tally up with the general sentiment and the general market expectations? Just have some kind of, leave some room for doubt. Okay. The other thing that I want to talk about, and this one is particularly poignant right now, because I'll give you two examples. Okay, so Peter Lynch talks about buying into growth companies. He talks about thinking about the sustainability of that growth. Okay, during COVID, it was like an accelerant for many of these stocks. Many stocks. It was not just the low interest environment. It was the change in the acceleration in the growth rate. And in some instances, that could have worked out well. In some instances, it didn't work out so well. Obviously, Peloton, it didn't work out too well. That company, you know, hit a bit of a good patch where it was able to sell because the gyms were closed. But the way the public markets work is that they reward future growth. If it'd been a private business, it probably would have done even better, because they wouldn't have been under so much pressure to outperform themselves to the prior year, and they could have been a bit more disciplined. So that's an example of something that did not work, and you end up with a balance sheet that has a lot of question marks on it. So for now, that business is doing okay. It has quite a lot of problems with its balance sheet. I don't know how it's going to overcome a lot of those problems. It kind of really needs two things to happen, which is interest rates to come lower and a bit of luck in terms of being able to refinance some of that debt. Incidentally, I'll just mention that when you look at a company that has quite a lot of debt, you don't need to be very detailed about this. Just look to see when the large majority of that debt is due. If it's due in about 15 or 18 months' time, you know, be careful, because once that debt becomes less than 12 months due, it becomes called current debt. That means on the balance sheet, it goes under current liability, and that is a problem to refinance. Once the debt is still as a long-term liability, you know, creditors will be kind of okay, and, you know, you can chop away bits of the debt here and there. But just think about that a little bit. Two things. So think about the sustainability of the growth. maybe the business is growing at a really fast rate right now, but it may not be growing at a really fast rate next year. So just think about that, okay? I find that a lot with consulting businesses. Consulting businesses have like a really strong period, and then it kind of fizzles out. Another example could be companies that done a large acquisition, and you get an increase in revenue growth rate one year, but the following year things kind of fizzle out. I'll mention just briefly Broadcom. They report their results this week, and they're in the process of acquiring VMware. So that's a massive acquisition that they're making. So that means over the next 12 months, there's going to be a large amount of revenue growth. But that revenue growth is not organic. So I'm already thinking about, okay, that business comes in, they acquire it, they integrate it. How does it look 2 years out? What's going to be the organic growth rate there? So, you know, I'm trying to provide things that are working out, have not worked out. Hopefully you can kind of take what you want from this topic and add it to yourself. And just to wrap up, I'm going to talk about Charlie Munger. So I alluded to this at the start. What I felt is really interesting about Charlie Munger's teachings is that he talks about, I've never met anyone that is successful in anything that doesn't read the whole time. And I've read Charlie Almanacs twice. Each page is like punched with like loads of insights. And it's not the kind of thing you can kind of really skim read through, because there's so much information that he puts in a few words. But he really talks about this kind of idea that keep learning, keep learning. So I think that's one thing that I want to talk about from Charlie. The other thing that I think is really helpful is thinking about inversion. He's always talking about invert. So inversion is like, think about what shouldn't happen so that you can kind of just have that kind of analytical mind. So it comes from kind of Charles Darwin's looking for the anti-hypothesis. So when Charles Darwin was developing the Darwinian theory, he looks at like, where did this chain in this species break? And he's trying to kind of think about contradictory evidence. So this kind of always thinking about inversion, I think, is quite helpful. Not look why something's going to work, but why it's not going to work. And then finally, I'm just going to highlight another thing that I think is really important that he talks about is that if you spend less than you earn and you invest shrewdly over a long period of time, you can't help but be rich. Now, he says, and as a follow on from that, he says, you don't need to be rich twice. You just need to make that money once and keep it. And that, again, is what I'm saying. Everyone can make money in the market. When the market's going high, everyone can make money. But it's better to do slow and steady and get there than have a really good period and then things fall apart. So as a parting kind of idea, I always say, just when you invest, just kind of separate out those investments, leave at least 4 or 6 weeks between each investment, because when things are working out, it's very conducive to putting money to work, but that's not the time to kind of get involved. The time to get involved is when things kind of take a breather, and they will take a breather. Nothing goes up forever. It will take a breather. And that's my little story for today. Do you guys want to kind of ask any questions or talk about anything?
I just wanted to say I really enjoyed it, and I'm looking forward to part 2 in a week's time.
Very kind of you. Thank you so much. You read a lot, Tomas.
Yep.
What kind of things do you think about?
Sorry, didn't hear the question.
I said you read a lot, and
Yeah.
I'm sure that you've read a lot about Charlie and Warren. Like, what is like one thing that you, from either of them or from one of them, that you kind of think about when investing?
The truth is that there are lots of things from each of them I think about investing.
Mm-hmm.
But I also try to remember what I can learn from them, but when not to follow them. It's, one of the favorite stories why you should always treat Warren Buffett like a god, but a god from a separate universe. That's why people ask me, why shouldn't I invest like Warren Buffett? Guys, you remember he has $150 billion in cash. So in order to make an investment, he needs to make something called elephant-sized acquisition. So for him, two small companies won't matter. And it's completely opposite for me, where I can buy, few shares of a small company in Poland or in the US, and it will generate enormous wealth for me because I can invest, small amount of my net worth in a small company, but it still pays off. But
So-
I started from the difference, the biggest difference I see, but I always, from Buffett and Munger, especially what I love, be humble. These were the guys, if you look at them and read their bios, it's like, oh my God, what have they achieved?
Yeah.
And whenever I look at Warren's, letters to shareholders or whatever Charlie wrote, it's like, be humble. You also said it, admit to your mistakes, analyze your mistakes. I don't know if Ray Dalio will be in this series or not. Ray Dalio also said that he's a professional mistake maker. He makes more mistakes than good decisions, but he just needs few good decisions to compensate for the wrong ones. So that's one of the things I always loved about Warren, about Charlie, about Howard Marks and others. They admit to mistakes. They analyze their errors. They do not live in a vanity. They are not stars. It's more like, I'm humble. I know what I did right. I know what I did wrong. I'm also, liked Warren, and one of my favorite quotes from Charlie, because in my heart, I'm a deep value investor. I'm a very quantitative guy. So I look a lot into valuations, but even too much. And recently, I even tried to, to write it and put near my computer when making a decision. My favorite quote from Charlie is, for now, it's better to buy wonderful company at a fair price than fair company at a wonderful price.
Can I just add to that momentarily?
Yeah.
Not interrupt, but just, this is so important, and it's that what you've just said right now about buying a slightly better business. Man, it's taken me so long to understand and appreciate that line of thinking, because I have been so guilty in the past of seeking out just cheap stocks. But these cheap stocks, man, it just kill me. It really just runs me over, because the businesses are running against time. You kind of, it's difficult. You need things to work out, because those cheap stocks can get so damn cheap, and you give up. And then you look back, you sell, and then when they actually turn around, you're not there. So I think that, yeah.
No, because I've had this, that I've bought too many stocks which I consider turnaround stories, but these were turnarounds only in my head. So I had the scenario for this turnaround and I was waiting for it to happen, but it didn't. So now I try to, when I want to buy something as a turnaround, I need to see twice as much signs of turnaround that I've seen before. Really something material.
I'm gonna take that line of thinking. I'm gonna use it. Yeah, that's really helpful.
Yeah, I've had this with commodities. I've had this with some, I worked as a pharma consultant for about 12 years in my prior life. So I've selected some companies where I knew there can be a turnaround, and for me were very cheap. One of them is Teva Pharmaceutical, so I can write a business case on that because it's a fantastic story. But the turnaround is only happening now, 5 years after I bought it. And things that are happening are exactly the things that I knew or predicted they would happen. They only did not happen 3 or 4 years ago. They're happening only, in 2023. So that's the thing. And I recently, even when I bought, recent purchases, some of the companies, Opera, Stoneco, for me, it's nice to go into the earnings sessions and see beat and raises. It's not cheap that PE is below 10. It's cheap in a way. And I think here is where Peter Lynch's price to earnings growth makes much more sense. So it's cheap in this sense. So mid-dozens companies PE, but rather impressive growth. And when I go into earnings, I see competent management, not blemish-free, but guys who know what they are talking about. They seem to be, and good results. And it's better than waiting for a turnaround that's, oh gosh, this company has PE of 3, but if they do this turnaround, I see this amazing opportunity just in front of them. Why don't you do it? Sorry, it was my reaction to first or further earnings, like, why don't you do it? So with Charlie about, buying wonderful companies at fair being better than fair at wonderful price.
Thank you so much for sharing that. Okay, I'm gonna wrap up here. Nicola, thank you very much for coming. Really appreciate seeing you. Hopefully you'll come next week. Tomas, thank you so much for the really helpful ideas. I'm gonna take some of those ideas that really helpful. Yeah, guys, I'm really delighted for today. Thank you so much, and I look forward to seeing you next time.
Thank you, Michael.
Okay.
Thank you so much.
Thanks,
See you next time.
bye.
Bye-bye.